overcoming behavioural biases can be difficult. Is there an easy solution? Hi, I'm Simon Russell. I'm the founder of Behavioural Finance Australia. This is the sixth and final in a series of videos aimed at helping individual share investors capture some of the benefits from behavioural finance. Now, in the previous 5 videos, we've gone through a whole bunch of issues related to our own biases and some of the potential distortions that can cause us to invest in shares that might make us feel good, but not necessarily lead us to the best returns, or can lead us to paying too much tax, for example. Now, in this video, what we're going to do is look at some of the solutions. So what I find in response to some of the sort of stuff that we've gone through is that some investors will say, look, that's useful, that's great, I'm going to incorporate some of the concepts that we've discussed into the way I manage my share portfolio myself. And that's great, that's certainly one solution. But I also find that some investors say, well, look, I hear what you're saying, this is obviously important stuff, but I also hear what you're saying, that that overcoming biases can be difficult. Is there an easy solution? Is there an easy solution for me as an investor? And also I get similar questions from some accountants and advisors saying, well, is there an easy solution that I can offer my clients as well, where they want to capture some of the benefits of some of the sorts of issues that you've been talking about. So in this video, I'm just going to go through the process that I went through when I'm looking for something that does a professionally managed solution that does sort of capture some of the effects that we've been talking about. I'll outline the steps I went through and some of the results that I found. So what I look for when trying to find something that would do the sorts of things that I've just described in these 5 videos, the sort of the low turnover and various things, I look for six broad characteristics. So this is what I look for. So first of all, I did look for low turnover. We talked about in, I think, video 2, we talked about how overconfidence can lead us to trading too much, and how that can mean that we can pay too much tax. So I wanted to find something that was low turnover. I also wanted to find something that was offering Australian share investors a direct share investment structure that allowed them to own either a direct legal or at least a direct beneficial interest in the underlying security, so they got some of the tax benefits from that as well. I also wanted a portfolio that was going to be tilted towards some of the types of stocks that don't make us feel good, the ones that perhaps we're not so predisposed, other investors are perhaps not so predisposed to buy, and therefore that's where those opportunities might lie. So these might be the low PE stocks, low price book stocks, for example. I also wanted something that was a rules-based approach. So we know that rules-based investing is one type of investment strategy or process that can help us to overcome some of the effects that we've talked about already. And then on top of that, I wanted just the basics to be covered. So I needed to be low cost and diversified. And ideally an investment product that was going to be available to clients of financial advisors and tax advisors. As I've been at pains to point out during the course of this 6-video series, the principles that I've been outlining are often correct in general, but will depend upon the individual circumstances, individual tax circumstances, individual financial position, goals and objectives. So really having that an investment strategy in the context of an advice relationship can be important as well. So I look for something that can be available to investors in that sort of context, as well as directly, of course, if they chose to invest that way. So when I went through those criteria and looked around at what sort of solutions were available in the marketplace, what I found was that some products ticked a lot of the boxes. So the sorts of structures that people might, or products that people might be familiar with, exchange-traded funds, do tick a lot of those boxes. You can find exchange-traded funds that are low cost. They are rules-based. For example, you can find some that are tilted towards the types of low PE stocks. These are perhaps sometimes called smart beta strategies, for example. Low turnover, low cost, diversified. So they're ticking a lot of those boxes. The only box I think that those sorts of products perhaps don't tick then is the structural aspect. You're not getting the direct beneficial ownership of the underlying securities through those types of structures, which means you have the potential tax implications of inherited capital gains and lack of ability to access corporate actions and some of the sorts of things that we've already discussed in earlier videos. So I think they tick a bunch of boxes, but not all of them. But one that I did find that ticked all of the boxes was an investment solution offered by a boutique Australian equities investment manager called Bellmont Securities, which is based up in Sydney. And the Bellmont Securities offer, as I said, ticks all the boxes. So if I go through those categories again, if I can remember those 6 in order, so they use is a very low turnover approach. What they do is that they will rebalance their portfolio over 366 days. So that means 366 days is important because it's waiting till at least 1 year has passed, so that any transactions in which a capital gain is realised, you know that you're at least going to capture the capital gains tax concession for that particular transaction. But of course, other turnover is minimised during the course of the year anyway, so you shouldn't really have too many capital gains tax issues at all. So it's low turnover. It is rules based, so that the turnover rules are part of the rules, but there are also other rules that relate to the types of stocks that can enter the portfolio, and those rules then do relate to things like the low PE and the low price book. So you're capturing some of the benefits of the distortions caused by some of these behavioural effects on other investors. There's a direct shares portfolio approach, so you do get the access to the underlying securities. You get direct beneficial ownership, which you can achieve through a number of different mechanisms, a number of different platforms, which will depend on the way you access the product. And that product is accessible via financial advisors and tax accountants, although the way you access it might be different depending on the business structure and the licensing arrangements of those accountants and financial advisors, or you can access it directly. And certainly it is low cost and diversified. So it ticks a whole bunch of those boxes. So that's a product that or a proposition that I tend to refer people to when they say, what can I do, or what can I offer my clients in the case of an accountant or financial advisor that does this sort of stuff that you're talking about, that captures these sorts of benefits. Now, more information about the Bellmont Securities portfolio and their approach is available on the Bellmont Securities website, so I'll refer you there for more information. But generally speaking, as we get to the close of this video series, for investors who are saying, well, this has been useful, but I'd like to know more, certainly feel free to get in touch with me. I can be contacted by my website, which is behavioural.financeaustralia.com.au. Whether you're an investor interested in more information for your own investment purposes, or perhaps you're an accountant or tax advisor thinking, how can you offer something like this, this sort of solution, this sort of methodology to your clients, feel free to drop me a line. As I've mentioned a couple of times already through this video series, I also have a book which deals with some of the issues that we've touched on pretty briefly during this video series. It deals with it in much more detail in the book, so for people interested in more reading material, I'd certainly refer you there, and details again available on my website. And of course, the disclaimer of which goes with all of this, if you're an individual investor thinking about making an investment choice, please speak to your accountant or tax advisor where appropriate before you do so. Okay, so that's about it. We're going to wrap up there, and I think I'll leave you just with a quick quote from Nate Silver, who's a prominent thinker and statistician, forecaster from the US, whose work I quite enjoy in this area. And he says, in fact, let me grab this so I'm making sure I'm going to say it correctly. He says, you should work to reduce your biases, but to say you have none is a sign that you have many.